You are investing every month hoping to build wealth. But what if you find out that your SIPs and other investments is actually not making money for you? And what if you're stuck in an underperforming mutual fund for years without realizing? There is a very simple way to avoid this trap and double your returns over time. Today I'll show you how to systematically invest in the right fund class at the right time so that a 10 lakh rupees can reliably generate say 25,000 every month without too much of risk. This is not a clickbait. By the end of this video, you will know exactly how to optimize your investments using what I call the targeted asset investing, a method that shifts your money into undervalued assets at the right time so as to maximize their returns. If you follow this approach, your money can possibly double every 5 years or 6 years and also generate a sustainable income. Now, would you rather invest in a fund that has already delivered a 30% return in the last 1 year or one that is down, that is minus 20% return? Most investors will jump into the best performing fund category. But history shows that those who have invested in the undervalued assets, they make more money in the long run. In this video, I will prove it to you with data and a practical strategy that you can start today. The difference between making 25,000 a month and struggling with poor returns is not about picking the best mutual fund. It's about knowing when to enter and when to exit different fund categories. And once you understand rebalancing, you will never be investing the same way. And if you enjoy such content, please do consider liking this video. It helps me stay motivated and do more research. Now, large cap versus small cap. Why timing matters more than selection? Look at this chart. This compares Nifty 50, that is the large cap index, with the small cap index over the past 20 years. You will notice something very surprising. Despite all the market cycles, both these indices have delivered the same annualized return, 14.9% over a 20-year period. So the natural question is, if small caps do not outperform the large cap funds over the long term, why take extra risk and invest in them? The answer lies in timing, knowing when to invest in the small cap funds, when to exit or reduce the exposure. The key formula is small cap divided by large cap timing strategy. Look at this chart. This one compares small cap performance relative to large cap over time. When the graph is moving up, small caps outperform large caps. And when the graph is moving down, the large caps outperform the small caps. For example, October 24, small caps had massive outperformance. But after that, it entered a down cycle. And the chart clearly shows this. Why does this matter? Over the last 1 year, small cap SIP returns have crashed to minus 25% to minus 30%. In contrast, flexi funds have done significantly better at minus 14%. When returns crash, investors panic, exit small caps, just like they chased them when they were at the peak. This is where smart investors take advantage. SIP strategy for maximizing returns. If you're doing an SIP into any mutual fund, you must understand how it is valued in relation to other categories of funds. Best approach, increase your SIP in undervalued categories, that is, funds below the mean valuation. Worst approach, chasing past returns, investing in categories that are overvalued. Right now, small caps are still overvalued compared to large caps, which means flexi cap, large and mid cap funds, these are more attractive. This brings us to an important concept, crowd behavior. Understanding market cycles and crowd psychology. Investing is just not about fundamentals. It's also about understanding investor psychology. When markets fall, the crowd panics and they exit, exactly when they should be investing. And when markets rise, the crowd piles at the peak valuations, setting themselves up for lower returns. This is why timing your SIP in undervalued asset is critical. Neuroscience of investing explains why it is hard to go against a crowd. A neuropsychologist found that part of the brain that feels the pain when standing against the crowd He is the same part that experiences physical pain when breaking a bone. That's why investors struggle to buy when prices are falling. It's emotionally painful. But history shows that those who can act against the crowd make the most money. The wisdom of the crowd, it fails in investing. This can be explained through a very famous experiment by Francis Galton, which led to the investing concept, wisdom of the crowd. Wisdom of the crowd works in some conditions where there is diversity in views. In a fair, a contest was held where people were asked to guess the weight of an ox that was at display. Each person had to put his guess in a chit and leave it with the organizer. So the people guessing the ox weight were not consulting each other. They were independent view. So they were diverse views. Finally, the chits were evaluated. While the individual guesses were all over and wrong, the most surprising thing was that the average of all the guesses came up to 542 kg. The actual weight of the ox was 543 kg. This result shocked the experimenters as much as giving some valuable insights into investing. The errors of guessing by different participants cancelled each other. In the real world of stock market too, one would expect that the emotions and biases of investors will cancel each other, and so the prices of stocks will be very close to fundamental value. Unfortunately, in real life, people have challenges. Guessing the weight of the ox in front of you is different from guessing the price of a stock. The reason is, in the stock market, analysis of the crowd does not negate them. They are influenced by the narratives, influenced on what the crowd is thinking, and they extrapolate this. This does not lead to independent thinking. It leads to herding. When animals herd in danger, they look in different directions for the threats. They run in multiple directions, reducing the collective risk. But humans herd differently. We look in one direction, driven by narratives. When prices rise, more investors are attracted, assuming everyone else is rise. When prices fall, fear spreads, people sell, worsening the decline. Result, market booms and busts. Because of crowd behavior, it amplifies the trend rather than stabilizing it. Now let us get into the core strategy, the key theme of today's video. If you have 10 lakhs, how do you maximize return while keeping the risk in check? The key is strategic allocation, investing in undervalued fund categories, not just chasing past performance. The market is not always efficient. Investors overvalue hot trends and they undervalue beaten down assets. So if you can consistently invest in a fund class below the median valuation, you significantly improve your chances of earning higher returns. Historical data: if markets and funds continue delivering past 20 years return, your 10 lakh investment could double in 5 years or say 6 years. Once your capital doubles, set up a systematic transfer plan (STP) for monthly withdrawals while keeping your original investment growing. But here is a caveat about managing market cycles and the drawdowns. If your 20 lakh corpus grows at an average of 12 to 15% annually, that's almost 3 lakhs a year or 25,000 per month. But returns are non-linear. Some years we will have strong gains, others will have drawdowns. This is where flexibility in withdrawal is crucial. In a bad year, reduce the withdrawals to avoid selling at a loss. In a strong year, withdraw more to compensate for any weak years. The key here is discipline. Compounding works over time, but only if you manage the cash flow wisely. To ensure consistent return, a flexible allocation strategy is essential. Tactical cash and opportunistic investing, such as keeping say 10% in liquid fund, ready for a market correction, can also generate 6% CAGR. Then you can look at momentum or thematic funds to accelerate returns by entering them at the right time. These are all satellite strategies, not the core. So why do you need a cash buffer? It lets you buy during the market dips and enter at very good valuation. Key market condition adjustments is key. If markets are overvalued, reduce the small and mid cap exposure by a certain percentage based on your profile and shift them into cash and debt. If the market corrects 20 to 30% anytime from the top, increase these small and mid cap allocations for higher growth. If interest rates are expected to fall, increase your debt exposure for better returns. Stick to SIPs to average out volatility. Rebalance every 12 months or so as to maintain your plan. Don't chase past performance. Buy undervalued assets. Avoid frequent switching. Compounding needs time. So the conclusion, have a winning mindset. If you follow market cycles, go against crowd behavior and invest with patience. You don't need to predict the next multi-bagger. You just need to be positioned ahead of the crowd. If you enjoyed this content, please consider liking this video, sharing it with your friends, and subscribing to this channel. Please do share your valuable comments. I look forward to learning from your experiences as well.